Howdy, my friend, welcome to Squirrel on Charts, your resource for advanced trading education.
Today's video is all about trade management. Let's face it, trade management makes or breaks your trade, yet it is rarely discussed.
Trade management involves your stop loss, take profit, how you deal with risk, and how you act in various situations that occur after your entry. Let me say it like this: without good trade management, you cannot become a successful trader. In the end, none of us can 100% see what the market will do after our entry. So being able to react to changes is crucial in order to limit risk and increase your profit. When you look at most trading education online, but also in books, you will see that the focus is always placed on the entry. While a good entry is certainly important, especially for your risk-reward ratio, it is still just one part of the equation. Other factors, such as the take profit and stop loss, but also the way you limit risk and increase profits, are just as important as the entry. So let's get into the topic. Let me start with the stop loss, because it is the most important part of trading and usually the reason why many traders lose money. There are two main things your stop loss should do. Number 1, your stop loss shouldn't be triggered from normal market behavior. If you want to trade the trend, placing a stop loss that can be reached by a pullback of the trend is a bad idea. Or, if you trade sideways markets, and you place your stop loss tightly to the reversal zone at either the top or bottom of the sideways market, then there is a good chance that you might get stopped out, and a second later you will see the market turn around again and go in your direction. But does that mean you just have to place your stop loss as far away as possible to avoid getting stopped out by the market's behavior? Absolutely not. And this brings me to the second thing your stop loss should do. Your stop loss should always stop you out when the reason for the trade is no longer given. If you want to trade the trend and the trend gets broken, then your stop loss should be there and stop you out. If you trade a sideways market and the price strongly breaks out of the range and ends the sideways market, your stop loss should stop you out. So whenever you place a stop loss, ask yourself these two questions. How far away do I have to place my stop loss to not get stopped out by normal market behavior? And furthermore, how close do I have to place my stop loss to get stopped out when the reason for the entry is no longer given? These two questions are essential, so please make sure to think about them.
When it comes to the take profit, there is one major mistake many traders make.
Often a new trader places his stop loss and thinks about his entry. Then he goes ahead and just places the take profit randomly at a price that creates a good risk-reward ratio. But instead of placing a random take profit based on your risk-reward ratio, here's what you might want to do. Ask yourself where the next zone is that might cause the market to turn around and go against your position. This is often a support or resistance area, either a horizontal one, or something like a trend line, or daily highs and lows, etc. If you place your take profit at such a zone, the chance that the market reaches your take profit before going against you is much better. Given that there are endless possible support or resistance areas on the chart, make sure to only pay attention to the most significant ones when placing the take profit. The problem some traders see is that the risk-reward ratio might be worse when they have to place the take profit at the nearest major support or resistance zone. Here are two ways to avoid that. First, you can have a better risk-reward ratio when you wait for a better entry. If the stop loss and take profit both have a fixed place, then you might have to wait for an entry that gives you the risk-reward ratio you desire. The second way is something that is difficult for a lot of traders. If you have chosen the best places for your stop loss and take profit, but the risk-reward ratio is simply not good enough, here's what to do: just wait for the next trade. Let's say you have entered the trade and placed both the stop loss and take profit at reasonable prices. But trade management does not end there. Partial closes are a good way of either cutting part of your loss or taking part of your profit. You can perform partial closes in many different situations. For example, the market goes against you, but the market is still in a good market phase, so you decide to close a part of your trade to limit your risk, while keeping the rest of the position open. Or maybe the trade goes in your direction, but after making a good run, the market suddenly starts to go sideways. Maybe you want to partially close the position and secure some of your profits, while leaving the rest of the position open, hoping that the market continues to go in your direction after that sideways phase. Another thing you can do after your entry is scaling in. This can be very dangerous, and I do not recommend this to new traders.
However, if you are more experienced, you can scale in order to increase your profit. But listen to me very closely, never scale in when a position is in the negative. Only scale in when you are currently making profits. A good way to scale in is when trading the trend.
You can increase your position size whenever the market ends a pullback and makes a new high or low.
What if the signal you initially traded is no longer valid?
What if you wanted to trade a single market move, but now the market started a longer sideways phase? Or maybe you wanted to trade the trend, but you have noticed that the trend has been broken. Or maybe you wanted to trade a sideways market, but the market is currently moving outside of that sideways zone. Okay, here is what to do: close the trade. Don't end up hoping for a continuation in your direction. Out of your own experience, you probably know that this hoping for a continuation does not work in 99% of cases. But as I have said previously, you should place your stop loss in a way that you will be out of the trade automatically whenever the reason for the trade no longer exists.
So, there you go. I know this has been a ton of information. But I hope that you do remember the most important points. First off, the way you manage your trade makes or breaks it.
Second, pay just as much attention to the stop loss and take profit as you pay to the entry. And third, the market can do anything after you have opened the position.
So make sure to continue managing your risk after entering the trade. Thanks for watching.
If you are interested in advanced trading education, feel free to subscribe.
Good luck on your journey. Bye.